Investors pulling money from emerging markets at the fastest rate since August 2011. Last week alone, nearly $6.5 billion was yanked out of these stock funds. So why are these markets breaking down? Here to weigh in, Kim Iskian, editor at the S&A Global Contrarian. Great to have you on the show, Kim. Thanks for coming on. I want you to dig down with me a little bit because a lot of us just getting our arms around these emerging markets and all the turmoil going on right now. What originally caused what looks like a real currency issue going on in so many of these countries?
Well, Jerry, what's happening is kind of like if you think of a big theater that's been slowly filling up with more and more people, that's markets going higher and higher. And at some point, someone strikes a match, or maybe a few people strike a match at around the same time, and someone says, fire. And there is no fire, but there are a couple of lit matches. And
what are those matches,
yells,
Kim? What's causing this? Yeah.
Those matches, well, we have a few things. First, we have the Federal Reserve talking about tapering and starting tapering. Secondly, we have China. And in China, we have growth going from around 8 or 9% a year for the past very long time to 5% a year, give or take. And that's spooking a lot of people. So what's happening right now is a few people are yelling fire and some people are stampeding for the exit. So we've seen emerging markets as a whole go down about 8%.
So explain to me, if you would, this issue with the Federal Reserve. I can understand how it affects our markets. That makes lots of sense to me. But why is it hitting Argentina, Turkey, South Africa, and Russia?
Well, Jerry, it's funny. In my travels, I often speak with people everywhere from Zimbabwe to Singapore to Russia who say, well, so what's the Federal Reserve going to do next? Because it's easy here to forget that the U.S. is the world's largest economy, and everything that the Fed does has an enormous impact in the rest of the world in terms of liquidity, in terms of money available in the rest of the world. And as soon as the Federal Reserve starts pulling back on the money that they pump into the system, it's not just the American economy, it's the global economy.
It's the global
economy. Huge impact.
Let me ask you something there, because isn't it the fact that investors were making comparisons between the yields on our treasuries, searching for something that would pay more, so they go into emerging markets where they can get a much better return, and now that that door is closing by the Fed, it's making everyone recalibrate the best investment for them? Help me understand.
You know, that's part of it. I think part of it is that people are saying, well, at some point interest rates in the United States are going to rise, so maybe that yield I can get abroad isn't quite as attractive if I can actually get more than 0.01% on my money in the United States. Another part of it is the concern about economies slowing down, because as soon as liquidity goes down, as soon as the Fed stops pumping quite as much money into the global economy, a lot of people are concerned that other markets around the world, they're going to see their growth decelerating quite sharply. And as soon as that happens, the attractiveness of those stocks falls quite sharply. So
let's show folks just the currency depreciation that's been going on across the planet here. Argentina, the peso down 23%. Turkey, the lira fell 6%. South Africa, rand down 7.5%. Russia, the ruble fell 7%. This is pretty dramatic stuff. And when you step back and you look at all the emerging markets, where do you see opportunity now? Where do you think that might be the right place to put some money in?
Well, I think Jerry, you make a good point there that the emerging markets is a hugely diverse asset group. And there are some countries that are doing quite well. There are a lot of countries that are not doing quite well. I think that if I had a fairly long-term perspective, maybe more than a year, I would be looking at starting to focus on some countries where valuations are low, where price-to-earnings ratios are already low, and where, for example, depreciation might actually help underlying companies. For example, a lot of companies, their margins actually increase as the value of the local currency decreases.
So what would you say would be what would be the good places to invest, keeping in mind that I know a lot of people worry about, if I put my money into this emerging market, can I at the end of the day get it out?
You know, I think that is a concern. I think that as long as you stick with some of the bigger, more liquid names, I think you're going to be okay. I think I would look at companies, for example, in Russia. There's some large oil and energy producers like Gazprom, where the margins are actually increasing. They're already very cheap. I think I'd look also at some markets that have been beaten down hard over the past year, where valuations have come down and where a lot of the bad news is already in there.
And what would those markets be?
I would perhaps look at focusing on Brazil. I would look at kind of off-the-radar markets like Kazakhstan. Even I would look also at some metals that aren't the big metals. I'd perhaps look at platinum, where problems in South Africa are going to lead to eventually the price of platinum increasing.
Kim, thanks for coming on tonight. Great stuff, really interesting. And I know it's a lot to talk about because there's so much going on there. Thanks so much for coming on.
Thank you, Jerry.